Thanks very much, and thank you for this invitation to speak to Rethinking. I've done a number of lectures over the last few years to students, undergraduates at various more progressive universities and economics departments, including UCL, and it's a pleasure to have the same audience or a different audience here today. I'm going to talk about the monetary system, and as mentioned, this book that we published on the UK monetary system, which will be the basis for my talk. Just get the slides going. The New Economics Foundation is a think tank. We've been around since 1987, focusing on ecological sustainability, social justice and well-being, and increasingly the financial system as underlying a lot of these issues. And I've been there for 8 years. So Adair Turner talked about the vital importance of money and credit creation and the financial system, and basically how this has been widely neglected in the mainstream teaching of macroeconomics, really since the 1970s and 80s, you could say, where models that included an active causal role for banks and for money and for credit and for debt were gradually taken out of the way macroeconomics was considered. And that left us, I suppose, with the circular flow model that you'll all be familiar with, really, of how the economy works. Workers receive wages, salaries, they use that to consume goods and services that firms produce. And we have this nice, elegant circular flow. On top of that, you would have government playing a role via taxation, providing public goods that the market is less able to provide via public spending. Again, it's a circular flow, and it's easy to conceive of the study of economics as about inputs, labour, capital, and production and exchange. Where do banks fit into this kind of model? Well, as Lord Turner was suggesting, the overriding proposal was that essentially banks intermediated. They intermediated people's savings to provide investment into the economy, so that we can sort of place, and I'm simplifying hugely here because I've only got 15 minutes, of course. Classical and neoclassical models are more complex than this, but essentially we can see banks as mainly in this intermediation role, making sure that workers' savings were more efficiently allocated to those parts of the economy that needed it most. This kind of model, which has come to dominate the sort of macroeconomic models, does beg a few rather large questions. Okay, one of the questions it begs is, where does the money come from in the first place? Okay, it's not entirely clear from here. Who do the firms somehow initially get some wages from somewhere and pay the workers so that they can consume the goods that the firm's producing, or do the workers find the money and use that to get those goods and services? How does the whole system get started, really? And equally, where do profits come from? If all of the savings are used up, as it were, in buying goods and services, and all of that money is then used to pay the workers, it's not quite clear where profits come from. And it's not quite clear how new firms start up, really, is it? I mean, where do they get that initial financing from if all of the existing finite savings are being used to go to existing firms? So this kind of model, which I've simplified hugely, does beg some important questions. And as Adair Turner was saying, in reality, banks don't play this intermediary role. They play quite a different role. And their role, as he was also saying, was understood by macroeconomists for many years prior to the sort of emergence of rational expectations and DSG kind of models in the 80s. Joseph Schumpeter was one of the great political economists who realised the role of bank credit creation was absolutely vital in the capitalist system, and he saw it as a key driver of entrepreneurialism and industrial development, as did Keynes, who in his treatise on money and other publications made it quite clear that he felt the creation of credit by banks actually precedes savings. It's not the other way around. It's not that people somehow have these savings and investment comes out of them. It's rather banks create purchasing power in the form of deposits, and that is used to fund investment. So it's the parent, not the twin, of increased saving. So what I'm going to talk about now is actually just how this process works today and how really it's worked for many years. So a few flashy charts for you. This is a simplified bank balance sheet. It's really very, very hard to understand this process unless you take an accounting, double entry, bookkeeping approach. And in fact, I would argue that applies to the whole of macroeconomics. If you really want to understand what's going on in the economy, you need to think of it as having assets and liabilities, households, firms, banks, and it's the interrelation between these that's really important. So this is a simplified bank balance sheet. On the asset side, you've got customer loans. On the liability side, you've got deposits. You've got banks lending to each other in the interbank market, and then you've got other assets and liabilities. I'm not going to focus too much on those right now because I've got limited time. But within this system, the question you might ask is, where is the money? Okay, and the answer is, it's basically here. These deposits, which are the liability to the loans that the banks create, are money. I mean, these deposits, you can pay your taxes with these deposits, these IOUs that banks create when they extend loans. So effectively, they are money. That's how you might define money. It's the most acceptable form of IOU. And this is money as well. These cash and central bank reserves created by the central bank. And the reserves are the final means of settlement within the interbank network. These reserves are what banks use to trade with each other when you make a payment from one account to another account within the economy. So there's a kind of hierarchy of money, if you like, and at the bottom, the most liquid form are cash notes and coins and central bank reserves. And it's upon these that banks are able to make loans and deposits, and they're dependent on these. So what is the actual process of money creation? Well, what happens is you sign a loan, an agreement with the bank, and the bank creates a brand new asset. So its balance sheet on the asset side has expanded, okay? Nobody else's balance sheet, nobody's savings have been reduced at that point in time. Nobody's taken money from anyone else. Okay, so that's an asset. You sign an agreement, the bank creates a loan, and it has an asset, money that you owe to it. But at the same time, the bank creates a liability. And that liability are deposits. That is a deposit that you can use to purchase goods and services in the economy. Okay, that's it. It's an expansion of the balance sheet. There's been no savings reduced. Absolutely fundamental point that sadly is not taught in many modern textbooks today. Okay, the next step is you spend that money on whatever you need to use it for. You buy your car, whatever it might be, and of course you reduce that liability that the bank owes to you is thus reduced. When you transfer your deposit, what actually happens in the interbank market is the bank transfers its reserves to another bank within the central bank settlement system, and I'm going to explain that shortly. So that reserve leaves the bank just as your liability leaves it and moves to another bank, and at the end of the day, that bank replenishes its reserves from other banks or from the central bank at the end of the day to make sure, again, that its balance sheet balances, essentially. So we go back to this equality that you must have at all times. And that is the process. The key thing to understand, I think, is the actual intraday clearing overnight settlement process. As I say, effectively you have a sort of hierarchy of money. within the interbank network. There's about 50 banks in the UK, but I just put the largest ones here. You have banks extending loans and assets and payments going on, but banks will settle with each other within that system as the day goes on. And at the end of the day, this is again highly simplified, stylized chart. At the end of the day, banks will simply make sure that that they have sufficient reserves to meet all of their payment obligations. Okay, that's essentially how the system works. The role of the central bank essentially is to make sure this system holds up, to make sure there is sufficient liquidity here in the system. And the question then is, how does this model, this reality of the capitalist system affect our thinking about the way the macroeconomy works? Well, we've talked about this real economy and this role of banks sort of intermediating between workers and firms. The reality is more like this. Essentially, the whole system requires the injection of credit at the beginning from banks and other financial institutions in order for their money to first arrive in the economy. Okay, firms borrow money to initiate production. If you're a firm who has no money, you need finance to get going. This is what Schumpeter talked about. Workers also borrow money for sort of consumption smoothing that Dale Turner was talking about. And this kicks off the process. But of course, this has a reverse side. At the same time, all of these loans must be repaid. So, and including government in this, by the way, governments also borrow in our modern monetary systems. They must pay back these banks and financial institutions, and they must pay them back with interest. And of course, these flows of interest and these quantities of debt and the amount of interest on those loans have real effects. That's the key point. It's not that this financial system is somehow disconnected from the real circular flow. It has real effects. If there's too much of a debt build-up here, it will concretely affect the abilities of workers to actually consume goods and services, which will affect the profits of productions in firms. Okay, so what we should be interested in macroeconomics is the size of these flows to where the credit is going in the economy, as Turner was talking about, and those flows of finance. Now, some people who were widely ignored did predict the financial crisis, and basically it was those people who had this kind of model of the economy. One of them is Michael Hudson, who talks very clearly here in 2006. Rising debt service payments will further divert income from new consumer spending, etc. These will affect the real economy. So this division between the financial and the real should be abolished. They should be thought of as one system. Do central banks have any control over this money creation process that I've talked about? What are the means? Well, what this chart shows you is the UK money supply, broad money, since 1964. And what it shows is a massive increase in bank IOUs or deposits from the you can see it really explodes in the 1980s there. So a very, very small proportion nowadays of money that is created by the central bank in the form of notes and coins or reserves. We've had this massive expansion, and it's due to a number of developments. It's due to deregulation, it's due to development in technology, use of electronic money to settle. And this is a key reason why central banks have less control, because they simply are only issuing about 3% of the money in circulation. Interest rates, as we've heard, are now seen as the main tool for central banks to control the creation of credit by banks. But increasing, as we've seen with the financial crisis, these seem to be a very weak tool. This is the drop in interest rates from 2008 after the crisis, apparently having virtually no impact at all on the change in lending to small and medium-sized enterprises. That's just one chart. There's a number of other you could select to suggest that this relationship has severely weakened. I'm just going to finish off by talking a little bit about the allocation of credit. I think Richard will probably cover this in more depth, but reinforcing what Adair Turner was saying, when we ask where do banks create money, and what do they put this new money into? You can see this very interesting dynamic in the UK. This, by the way, is domestic bank lending, so it includes international banks, not non-domestic UK banks, by a broad industrial sector. And what you can see in 1986 is close to 40% of all new credit creation by banks went into what we loosely call the productive sector: manufacturing, distribution, communications, retail, etc. By 2013, we can see this is down to closer to 8%. I think Adair's estimate was it was more like 15%, and that's because there is some leakage from commercial real estate, the red here, from mortgage lending, which is this purple, and from personal consumption here. But what you can see is this broad pattern of sort of financialisation of UK bank lending, an increasing amount of credit going into housing, mortgages, an increasing amount going into the financial sector, which actually reaches its peak in 2008, and then has been reduced. But the reduction in lending to the financial sector has not been taken up by productive lending, rather it's been taken up by this big increase in secured lending, mortgage lending, and an increase in consumption. So it's this that's driving our recovery. And then the question is this form of debt that doesn't actually contribute to real GDP transactions, is this a sustainable model? So I'll leave that there. This chart essentially shows the same thing from 1980, the detachment of broad money from GDP over the years. I think I'm probably running close to time. So I'll just finish by promoting New Economics Foundation's book, advise you to buy one, and that's my contact details. Thank you.
Or continuing from where Josh has left us, and to some extent extending some of the reflections about shadow banking that you heard early in the morning from Lord Turner. Just to say that these reflections are part also of trying to teach students in UWE in Bristol, where I'm teaching, trying to teach them about shadow banking, and from discussions with Joe Mitchell, who's a colleague, and so everything that is wrong, blame it on him. I would like to start by pointing out a quote from Werner from the European Central Bank, one of the wiser academics there, that has argued, very much like Lord Turner, that we need plurality in economics. And we need plurality in economics because, he argued, policy institutions, including central banks, have been paralyzed when the crisis came, precisely because they didn't have the tools, or because the models that they were using did not take into account the possibility that the crisis will happen. And the same sort of theme comes from Ricardo Caballero, for those of you who read mainstream macro. He's an MIT professor, and in 2010 he wrote, I think, a quite devastating critique of his own mainstream economics. And one of the arguments he made was to say, we have had a core mainstream macroeconomic approach where we do modeling in the SG models, and we had in the periphery research done on all sorts of interesting things, including, I put there, liquidity evaporation, collateral shortages, bubbles, panics, fire sales, and risk shifting. And these sort of periphery issues are the ones that turn out to be important in the crisis. And some of them, I will argue, are very characteristic and come from the way that the shadow banking operates. So what Caballero argued, and maybe this is to warn us that even the mainstream is moving forward and trying to incorporate some of the fundamental insights that we got since the crisis, is that we should start from trying to understand what happens in the economy. He calls it the real economy, but I would argue we should try to start from understanding what happens in finance. And so the question that I want to address today is, what do changes in finance, particularly the rise of shadow banking and intra-financial system trading that Lord Turner was referring to earlier, what do they imply, or what do they mean for our reflections and our understanding of how money is created, and for our reflections on financial stability? And I'm sorry, this is quite small, but it says the same thing that Josh says, so I'm not going to go very rapidly over it. This is Bank of England in April 2014, so 3 months earlier, recognizing what post-Keynesians, among which I guess I would number myself, what we have said for a really long time, that loans create deposits, right? And they had this very nice balance sheet approach, And they argued, yes, there is no the banks create loans, and by creating loans, they create the money of our economy. But we need to recognize that the extent to which the system or the money in our economy moves depends to a certain extent on two things. It depends on the demand for loans, and it depends on the central bank's ability or willingness to provide reserves when, as Josh explained earlier, a bank who creates, in this case, a new loan and a new deposit might lose that loan, might lose that deposit when the customer here wants to pay for a house for which she has taken a mortgage on. So in order, when this commercial bank loses this deposit, might lose the reserves, so the central bank comes in and it provides these reserves, or the commercial bank can go to the interbank market and borrow from there. And because the central bank can set the cost of reserves by targeting the unsecured interbank market, it can control to some extent the expansion of lending in the system, and then it can influence the money in the system. And what I want to argue very quickly is that that's a very interesting story, and we should be a bit wary when sort of establishment institutions start to recognize a story that we think it's quite heterodox, but it doesn't capture very much of what is happening today in modern banking. So if you look here, both on the asset side and on the liability side, what we have is that banks are less and less engaged in relative terms with the real economy or with lending to households and firms and taking deposits from households and firms. For example, for Great Britain, the deposits of non-monetary and financial institutions as a share of overall assets, the lending to, as a share of overall assets is less than 30%, okay? So what I want to focus on is what's happening between those 30% and the 100%. And this is from the Liikanen report, the 2012 report on the state of the European banking sector. I would suggest for students who are interested in finance, it's a very good read of what's happening in European banking, or what was happening. So I want to start trying to reflect on what banks do now. I'm trying to use the balance sheet representation of Bank of England, right? So start with a bank that has on its asset sides loans and reserves, and on the liability side it has deposits. And to try to understand intra-financial system activity, I put there a pension fund that has government debt on its asset side, and it has liabilities there. This is exactly the picture that Bank of England uses in order to explain how quantitative easing works in that 2014 report that I referred to earlier. So let's assume that the bank wants to buy some government debt from the pension fund, right? In order to do so, it buys that government debt and it issues deposits which will appear in the assets of the pension fund. Now, at this point in time, there is a dilemma, or there is a question for both the bank and the pension fund, in the sense that the bank is worried that if the pension fund takes that deposit somewhere else, it might lose reserves, and it doesn't want to do that. At the same time, the pension fund is worried that if these deposits are quite large, and they are not covered by a deposit guarantee, the pension fund has an unsecured exposure to the banking sector, to that particular bank. So what can they do about it? And the beauty of shadow banking is that the financial institutions have come up, I argue, with an instrument that allows this unsecured exposure to become a secured exposure by undertaking a repo operation, right? So instead, the commercial bank agrees with the pension fund there that instead of an unsecured deposit, it will take back that deposit from it. It will issue a secured liability that is called a repurchase operation, for which it will provide as collateral the government debt that it has bought from the pension fund. So what the pension fund has now, it has a commitment from the bank for the amount that the deposit was there, but that is covered by that government debt. Okay, so in legal terms, the pension fund is the legal owner of the government debt that it has sold to the bank. However, in economic terms, the pension fund does not assume any of the risk or return on the government bond. In economic terms, the commercial bank is still the owner, and the pension fund, if it does a repo, it commits itself to send back all the coupon payments on that government bond back to the original, or back to the commercial bank. And this is another way of saying that the commercial bank is funding itself in wholesale repo markets and provides collateral. This is an operation that can be reversed. It can be overnight, this repo operation, and it can be 1 week, 1 month, 1 year. Okay, and the beauty of it is that once the pension fund becomes back the legal owner of that government bond, it can actually lend it onwards if it has the right to reuse, or it can do, we say can do rehypothecation. It can lend it on back onwards to a hedge fund that can then fund itself by issuing the same sort of repo liability. So if you think this is quite unusual or quite a small technical instrument, I can tell you from my research on the financial transactions tax that the European Commission has proposed a couple of years ago, that the repo market was at the core of the debates on the FTT, and you can see here from all these quotes that what banks in Europe, and pension funds in Europe worried most on the FTT was the repo market. For example, it was expected that the Dutch pension fund industry would incur losses of an order of 3 billion, and half of them would come from their activity in the repo market. The same for the FTT on commercial banks, much higher losses than from their derivative or equity activity. And here, both the French Minister of Finance and the French governor of the governor of the French Central Bank made the same point. A graphic representation of this, again, is to see that what we traditionally think of money, which is M2 deposits of households and companies, you can see a very rapid pattern of, very rapid growth in the repo liabilities that before the crisis has matched the growth in traditional money, and the same from Hyung-Soon Shin, the same pattern we see here with the red line in the US. So both in Europe and in the US, we have seen this growth of what the literature on shadow banking calls shadow money, or money-like liabilities. One very important part of the story here is that almost all of these repo transactions or shadow liabilities are supported with government debt. And you see here around 80% from 2002 and to 2008, around 80% of repo transactions were collateralized with government bonds. In Europe, it's largely an interbank activity. Okay, so starting from that, I think, given the constraints of time that I have, we can try to think of a new way, or we can try to theorize how the shadow banking sector creates and generates shadow money. If you recall from what Josh has said earlier, and from what I tried to explain very quickly, the scope of the expansion of what we call traditional money depends on the price of reserves that the central bank injects into the system, and we call that base money. In the shadow banking sector, that is about securities financing, so trying to finance the government bond with a repo liability. The pace of the expansion can be captured through the leverage of the financial sector, intra-financial system activity, and the system is very much dependent on government bonds. So what we have here is that in this new system of financial intermediation and credit creation, the base asset or the base money is no longer reserved, but we have a base asset that is government bonds. And there is in the literature, there is an argument then which kind of which questions a lot what we know now about austerity. Zoltan Poshar in particular has argued that if you think about securitization in the US, it has grown as fast as it has because institutional cash pools, including pension funds in the US, did not have enough government bonds and could not generate enough repo liabilities, and therefore the private financial sector emerged to generate those kinds of high quality assets that governments weren't willing to issue. So in a sense, Governments should do fiscal expansion as much as they can if they want to support or if they want to reduce the sources of vulnerability in the shadow banking sector. Okay, and then very quickly, there are a set of very important new challenges that come from thinking about money creation or credit creation in the shadow banking sector. Financial fragility doesn't look the same. It has to do with leverage cycles. It has to do with practices of accounting that I don't want to get into it, but Financial Stability Board has a lot of stuff on it. The crises look different. Crises are no longer queuing in front of a bank in order to be able to withdraw your deposits, but crisis happens as runs on repo. So trying to withdraw the repo funding from, for example, the pension fund would withdraw the repo funding from the commercial bank. And as early as 2001, the Bank for International Settlement has already done some research that shows how crises happen in a system that is dominated by shadow money. Okay, very last point, crisis management is different because we can think about quantitative easing in that way. In a crisis where these base assets are no longer safe assets or are no longer accepted as under supporting repo transactions, then the central bank has to step in and change reserves for base assets. And I think this is a way of interpreting quantitative easing that is much more useful, and it can help us understand why the ECB took so long and was much less successful in stabilizing European finance as opposed to Bank of England or the US Fed. And I'll finish with this. Very quickly, shadow banking involves state-facilitated creation of private money, but uncertainty is no longer about the liabilities that banks are issuing, but uncertainty refers to the status or the safety of that base asset. In other words, for the central bank to be able to provide financial stability where shadow money is important, the central bank has to be willing to coordinate with the government and with the debt management office, and has to step into government bond markets and ensure their liquidity. So Perry Merlin has wrote a lot about this. Central banks become repo dealers of last resort. And for those of you who have finished your undergrad and want to do master thesis, I think this is a very, I want to do master thesis in political economy. Trying to address this question of how to regulate repos is a very fruitful avenue to go forward, because the FSB has tried to do it, Bank of England has tried to do it, ECB has tried to do it, and every single policy initiative to try to regulate the repo market has been watered down to almost not biting at all. Okay, thank you.
So I'm going to talk about democratizing money and fixing the system that we have so that we don't have the crises that we've had in the last few years. When it comes to figuring out what we need to do about how money is created and how to change the system, there's two key questions that you need to ask. The first one is, who creates money and who should be responsible for that? In the current system, it's the banks that create most of the money. So 97% of money, as Josh and Adair explained this morning, is created by banks when they make loans. All of those numbers that you see in your bank account are actually created by banks. It's only the cash, the paper money and the coins that is actually created by the Bank of England or the US Federal Reserve these days. And that's a fact that has missed many economists, and actually many politicians don't understand this as well. The second question is, how is that money used when it's created? How does it get into the economy? And what effect does that have on the economy? And in the current system, it's because it's the banks that create money when they make loans, they decide how that money will be used and what it can be spent on. So again, as you've seen, most of the money that they create goes straight into the property market or into financial markets. Very little, depending on which measure you use, between 15 and 8% of the money that they create goes into the actual productive businesses that create jobs and employ people and actually count towards GDP. So we have basically put the banks in control of creating money, and that has also put them in control of shaping the economy. They're driving the shape of the economy that we have today. And there's a real problem when you combine these two decisions, how much money to create and how to use that money. Because if you can create money and then decide how it's going to be used, and you benefit from that process, you're going to have an incentive to create too much. So when it's the banks that are creating money, their job is to lend. the more they lend, the more profit they make. And they have incentives and bonuses and commissions to encourage them to keep lending. If you're working in a bank and you don't lend, you get fired if you don't meet your targets. So all of these people that are making decisions about whether to create money or not are doing it with incentives that are always driving them to create more. And they're not really thinking about the appropriate amount of money for the whole economy. They're thinking about their own self-interest. And what that has led to is this enormous creation of money. Basically, the amount of money in the UK economy doubled in the 8 years running up to the financial crisis. And most of this money was flooding into property and financial markets, and that was one of the main drivers of, one of the main triggers of the financial crisis. The consequences of this, firstly, because all money is created when banks make loans, it means there is debt to correspond to all that money. So if there's money in your bank account, somewhere else in the economy is going to have some debt, and all that debt has to be serviced. Personal debt now in the UK is close to the historical all-time high. It's forecast to be higher than it was when the crisis hit by 2018. So we have an economy that's dependent on banks creating more money and people going further into debt to keep the economy growing. This is what Adair Turner was talking about this morning, where he said we seem to need credit to keep growing faster than the rate of GDP growth to keep the economy growing. So we have an economy that's dependent on debt. It also drives inequality, primarily through inflating house prices. So if you're already wealthy enough, or you've got some support from parents to get on the housing ladder, you benefit from this 20% rise in house prices that we've had in London over the last year. If not, you end up paying off somebody else's mortgage. And over the period of a lifetime, if you never get on that ladder, you end up potentially £500,000 worse off at the time when you retire. My flatmate has made more money in the last year from his house price going up than he's actually made from working. And this is, when you look at this across the economy, this is one of the big drivers of wealth inequality, particularly in the UK. And also, obviously, it led to the financial crisis. So what we need to do, what I think we need to do, is take the power to create money away from banks, eliminate this conflict of interest where the people creating money also have the incentive to create too much of it because they benefit from creating money. And the way you can do that is through a reform to banking that is sometimes called full reserve banking, in contrast to the kind of fractional reserve banking that you have in the current system, although that's not an accurate way of describing it really. But this is an idea that came out of the Great Depression around the 1930s. There's a lot of economists talking about this idea of stopping banks creating money, and it actually went right to the level of the president at the time in the US. This was one of the plans that he was considering, and the alternative was the New Deal, and in the end he went with the New Deal, which helped get the economy going again, but in the long term hasn't worked out particularly well for us. So the way that you remove the power of banks to create money is through a few fairly simple technical changes to the way they work. I won't take you through the balance sheets and all the rules right now, but basically what it would mean is that if you're a customer of the bank, you would walk into the bank and you would have two options. One is that you would have an account where your money is kept safe, where the bank isn't able to touch it. You'd still have a debit card or a checkbook or internet banking connected to that, so you can make payments and you can receive a salary, but the bank never touches the money that you place in that account. The money would actually be stored electronically at the Bank of England. So if your bank fails, because it's made risky investments or because it's badly managed, the money that you said I want to keep safe is still kept safe. Now, if you have extra money that you want to save and you want to earn some interest on that, you would put that into a different account, which we're calling an investment account. And you would know full well that you are taking some risk with this money, because there isn't really such thing as a risk-free investment. If the money is being invested in the economy, there is a risk that it might not come back. In the current system, we have the impression that bank savings accounts are risk-free. They're not risk-free, it's that the risk is passed on to the taxpayer. And because of that, you end up with much more risk-taking than is actually best for the economy. So you have these two types of accounts. Banks, because of this, are no longer able to create money when they make loans. They would actually just be taking money from savers and lending it to borrowers, which is actually what the rest of the financial system does. The banking system, the banks themselves have this kind of privilege where they are able to make loans by creating the money that we use. Every other part of the financial system can only make loans by getting money from somewhere else first. So there's this kind of special privilege given to the banking system, which is, it's an accident of history, really, which I'll explain in a minute. So if you stop banks from creating money, then the question is, well, who's going to create money in place of that? And you can't just fix the money supply at one level and never increase it, because your economy is growing, and you need the money supply to grow alongside it. So we would suggest that the Bank of England, instead of having indirect control over this system through the use of interest rates and different regulations, which is what they try to do now. They try to use the base rate of interest to influence how much people borrow and how much money is created. That system doesn't really work effectively. So instead of them having indirect control over what the banks are doing, you give them direct control over creating money. And then if there's a recession where you have the opportunity to put more money into the real economy, they have that facility to create additional money. They don't have to lower interest rates to 0.5% and just hope that people will go out and take out more loans from the banks. So they'd have a way of actually driving the economy much more effectively than either quantitative easing or the use of interest rates. Then once they've created that money, you can't let them decide how to spend it, because again, that'll give them a conflict of interest. If they were deciding whether to create money to pay for high-speed rail, and some of the staff at the Bank of England get the train in from Birmingham every day to the office, and they're going to have an incentive to create that money for something that would benefit them. So you have to separate this conflict of interest, these two decisions. And what we're suggesting is that the Bank of England creates the money, but then it transfers that money to government, and government decides how to spend it in exactly the same way that it decides how to spend all of the tax revenue that it receives. So it could spend it on additional government spending. It could reduce taxes, to remove lower paid people out of the tax completely. Or it could actually just give everybody a share of the money that it's created. Everybody would get what is called a citizen's dividend. But the important thing is that instead of, in the current system where banks create money and put it into property markets and financial markets, with this system, the new money would be coming directly into the real economy. So it would boost spending and GDP and employment far more effectively than money created by the banks. We've developed this idea into a 330-page book, which is called Modernising Money. That was recently picked up by the chief economics editor at the Financial Times, Martin Wolf, where he wrote an article. He just called it "Strip Banks of Their Power to Create Money," and he ends the article by saying basically, this isn't going to happen overnight, but we need to consider these ideas, because when the next financial crisis happens, as it certainly will, we need to be ready with a reform that would actually deal with these problems. But this idea of stopping banks from creating money, we often get told this is too radical. You can't do something that is such a big change to the system. But the interesting thing is, it's actually happened before. And it happened in 1844, and it was implemented by a conservative government at the time. Now, the situation was that in the 1840s, the only legal form of money that was created by the government was coins. And people would put their coins into the bank for safekeeping. And the bank would give people a piece of paper which says, you have deposited £5 and we promise to give you the money back in exchange for this piece of paper. That was like a receipt to show you basically what your bank balance was. But over time, people started to use the receipts to pay each other instead of using the coins, because it was more convenient. Gradually, people stopped seeing the difference between the paper receipts and the actual coins themselves. They saw them as effectively the same thing. And what that meant was that the banks realized that actually nobody's interested in what's in the vault, what's in the safe. If we just write a number on a new piece of paper and lend it to somebody, they'll accept it as money, they'll pay interest on it, and we can take the profit from that. So naturally, they had literally acquired the power to print money. They had a huge conflict of interest, and they created far too much, which caused a banking crisis. It caused a financial crisis in the UK around that time. So in 1844, the government stepped in and said, we're going to change the law so that banks can no longer create paper money. That law has never been updated, even though now 97% of the money that we use is electronic. Now, there's never been any debate in Parliament which has actually said, yes, we want our money to be created by the banks. It's a system that's evolved over the last 170 years. And look where it's led us to. So just a couple of the common responses that we get to this. The first one is that if you, critics will say, well, if you stop banks creating money, that's going to cause a massive contraction in how much credit there is in the economy. And that's going to harm businesses, it's going to contract the size of the economy, and it will lead to unemployment. Now, there's quite a few problems with that criticism. Firstly, the important thing for keeping the economy growing is that you get money to businesses that can actually create value and can create wealth. That is something that the banks have lost interest in doing, is the chart that Josh showed where the lending to businesses is becoming a smaller and smaller part of what banks do. So they're no longer particularly lending very much to businesses. Some of that lending has been taken over by things like peer-to-peer lending. And peer-to-peer lending doesn't create any new money. It just takes money from a saver and gets it to the borrower or to the business. A lot of the other investment that takes place in the economy isn't done with money that is newly created. It's done by the investment managers, the different kinds of investors in the financial markets, and that's all done with pre-existing money. So you don't need to have banks creating money out of nothing in order to make sure there's enough credit in the economy. And then the second one is that the second common thing is that actually we don't need to do this. We can just regulate the banks. But what that means is you're relying on the small team of regulators to outsmart this huge team of people working in the banks. And the state of regulation now, I was speaking to a senior lawyer at one of the big banks. She said that they are dealing with 90 pieces of regulation at the moment which affects them. One of those pieces alone is the 2,000-page Dodd-Frank bill. So when you use regulation in this way to try and stop the banks doing anything stupid, you create so much complexity that it's bound to be full of loopholes, and you will not stop banks from doing what they want to do. And our approach to it is to say, well, look, banks are going to do things that are stupid. They are going to make mistakes and they're going to fail. When they do that, they should be allowed to fail without being rescued from the taxpayer. And the most effective way of doing that is to remove their power to create money, so that even when they do fail, you still have a monetary system that works and that can power the real economy. And I am exactly on time to the second. So.
I'd like to talk about non-fiction economics. It's a common and recurring phenomenon. We're presented with an official story. And there is this story, but then there are also facts. In economics, a fundamental rule is that the truth is usually the opposite of what they tell you. Textbooks tell us the official story. I'm obviously talking about the mainstream textbooks, neoclassical textbooks. And of course, those who are here are already quite encouraged to look for the facts. Just an example, real growth. We hear a lot about real growth, we've got to look at real variables that we're being told. But actually, real growth is unreal. Nominal growth is the real. Now, this is a great example of how in textbook economics, two wrongs, we're told, make a right. What we observe is actually nominal data. Your fees, student loans, wages, stock prices, currencies, all nominal. Real growth, real GDP, well, that's a theoretical concept. It's not directly observable, because we only have nominal variables to observe. You make a whole lot of assumptions, and you then create something theoretical that is called, out of the nominal growth, and that you call real growth. Good example, Japan. for the past decade, Japan averaged real GDP growth of 0.9%. Well done, Bank of Japan. You know, that's pretty respectable for an advanced industrialized nation, grow by 1%. Large-scale unemployment, big recession, 20-year recession. Why is that? Well, nominal GDP growth averaged minus 0.4% over the past decade. And of course, when nominal growth, which is the real, contracts, because balance sheets are also nominal terms, everything is nominal terms, you get corporate bankruptcies and unemployment. And Japan also experienced deflation of 1.3%. In other words, inflation minus 1.3. How do we calculate real growth? Well, we take the nominal figure, minus 0.4, and we subtract the inflation, minus 1.3. So shrinking nominal growth plus deflation, two very bad things, gives us, hey presto, positive real growth. No worries about the economy. So under deflation, of course, real growth is theoretical, quite unreal, a purely nominal figure, while nominal growth is very real. And of course, its shrinkage leads to some real things like bankruptcies, unemployment, and record high suicides, as we've seen in Japan. So this is how economics tells you the opposite of what's really happening. Let's look at the business cycle. The official story is it's driven by interest rates. That's the number one variable. That's driving the economy. That's what the central bankers tell us, the stockbrokers, the journalists. And of course, you know the story. Lower rates stimulate the economy, we're being told. Higher rates slow the economy. And that story is being retold so many times that we all assume, well, surely I don't have to check this because that's been checked and tested and proven 100 times, 1,000 times. You know, they've been saying this for decades. Joseph Goebbels said, the big lies are the most credible ones because people just can't imagine that that's a lie. So what's the empirical evidence for the official interest rate story? I'll tell you, there isn't any. There is no evidence for this whatsoever. Some examples of how interest rates and growth are related. Do a scatter plot, nominal growth, nominal rates. You can do it for real, so-called real actually as well. You get the same picture, a positive correlation on the left side for Japan, upper one, and for the US, the bottom one. So positive, not negative correlation. So higher growth and higher rates go together. Maybe the answer is in the timing. Let's look at the timing. Actually, what you find is that it's GDP that moves first, like in Japan, 87. With a big gap, interest rates follow. GDP decelerates, interest rates follow. Now you'll say, okay, granted, the central banks are behind the curve, they influence the short-term rates. What about the most liquid market in the world, the bond market, US treasuries? Same story. GDP accelerates, interest rates follow. GDP decelerates, interest rates follow. Time lag of 1 year, sometimes more than that. So this is what psychologists call cognitive dissonance, and economists are very used to living with that. The official story is high rates lead to high growth, to low growth, and low rates lead to high growth. So the inverse correlation and the causation from interest rates to growth. And the reality is different by 2 dimensions. The correlation is not negative, it's positive, and the causation, of course, Granger causality, the statistical causation, is from growth to interest rates. So what we can observe, and what is supported by empirical fact, is that when we have higher growth, that will raise interest rates. Lower growth will lead to lower rates. So interest rates cannot be the cause of growth, because they're the result. And of course that contradicts the official story big way. It raises some questions. If it's not rates, what determines then economic growth? And why do central bankers keep talking about interest rates as their alleged number one policy tool? Of course, trade secret is central bankers don't actually use interest rates as their monetary policy tool. They couldn't. It wouldn't make sense. Markets. The official story is markets clear. Equilibrium. Have you heard that before? And of course, they're efficient. We don't even need to go to the efficiency. Let's look at the more basic argument that markets clear. And therefore, prices are key. Those of you who've studied economics, hands up. Who's done economics? Okay, good. Well, who hasn't done economics? We have a few brave souls. You haven't missed much. Here's a catch-up. There's just one chart in economics. That's it. We can use this for the labor market, then the price will be wages. We can use it for the economy, prices in general. We can use it for money. This is the price of money, interest rates. So price here, quantity there, downward sloping demand curve, upward sloping supply curve. Where the two intersect, that is equilibrium. Of course, if the prices are too high, you get excess supply pushes down prices. If they're too low, excess demand pushing up prices. Therefore, we've got to be in equilibrium. You've heard it many times, and is used for the FX market, for the labor market, for you name it. Small print. We have to make some assumptions. Here they are. Perfect information, complete markets, perfect competition, instantaneous price adjustment, zero transaction loss, and. So we assume this. Then we can show that markets clear and prices are key. All right? Now, let's be naughty and let's just talk about facts and reality. Let's actually be very generous. What is the probability that one of these assumptions will hold? Let's say, okay, let's give them more than half, more than 50%, 55%. That's very generous because if you look at these assumptions, well. So each assumption has a probability of being true of 55%. So then what is the probability that all assumptions are jointly true? You're all good at maths. You study economics at UCL. Of course, that's 0.55 to the power of 8 is less than 1%. And that is if we're very generous and give them 55% for each assumption. In other words, the official story is, we've shown that markets clear, there's equilibrium. Actually, neoclassical economics has done a very good service to mankind. It has proven that the assumptions required for equilibrium are so unlikely to hold ever that we know for sure markets never clear. There is no equilibrium. Markets are rationed. Rationed markets are determined by quantities. The short side principle applies. Whichever quantity of demand and supply is smaller determines the outcome. And that short side has power. And that's why this is a big taboo topic. Because, we're not supposed to talk about power. Well, that's the reality. All markets are rationed, and there is a bureaucrat, whether they work for the private sector or not, who makes the allocation decision. When you enter the labor market, you'll find out whether the job, there's 10 applicants, you're sitting outside waiting for the interview, will actually be given to the one who says, I work for the lowest salary. This is not how jobs are allocated. Well, this is not how anything is allocated. And of course, the short side extracts benefits. Think about how Hollywood starlets are selected. So, power is actually the reality of this world. All markets are rationed and determined by quantities. So, money. The demand for money is infinite. And it's my fault, I admit it, because I think money is very useful. I want to have more, always. And because it's a horizontal addition of all demands, because of my demand for money being infinite, of course the total demand for money is infinite. You guys are much more modest. Therefore, what is the shorter of demand and supply? Of course, it's supply of money. So who supplies money? Well, we know the answer to this one. The textbooks wouldn't give you the answers. Textbooks say, we don't know what money is. The Federal Reserve. There is no answer to such a difficult question. What is money? I mean, how should we know as a central bank? The leading textbook used at master level economics courses in the UK, David Romer, Advanced Macroeconomics, says on page 3, incorporating money in models of economic growth, would just obscure the analysis. So the fact is, money is, of course, not neutral. It affects everything. That puzzles economists that make other assumptions. And, well, in the world that we live in, we therefore have to look at who creates and allocates money. And the answer to that you've heard. When I did a survey of the public, 84%, this is over 1,000 respondents, perhaps biased in the sense of being more intelligent or educated, let's say, than the average person, because it's done near a major university. 84% responded, well, the government or the central bank creates the money supply. But of course, that's not true. And as you've heard and as we know, it's the banks. Banks create the money supply. And so banks behave differently. The Bank of England has finally, after 300 years, admitted that, it's actually the banks. So in 300 years' time, we will hear a bit more interesting stories about how central banks work. It's certainly not that banks are financial intermediaries. I don't need to go through the mechanics. You've heard that. And when money is created through banks, which, by the way, we need to measure through bank credit, not deposits, because deposits is money out of circulation, potential money savings. It's the money that is used for transactions that does things, and that's better measured by the credit side. So we've got the quantity theory of credit. When credit money is used for non-GDP transactions, this is asset financial transactions, of course, results in asset inflation on the up, and when it's restricted, then the bubble bursts, the bust banking system follows. But money can be used for GDP transactions when it's used for consumption, consumer credit. Of course, you create more money, more demand, but not more goods and services. You must have consumer price inflation. That's not good either. So these are unproductive forms of credit, unsustainable, and therefore policy should be implemented to stop them, prevent them. But there is a good form of credit, money creation. That's when credit is created for productive purposes, for the implementation of new technologies, increasing productivity, of course, defined in the proper way, including the environment, because it can't be productive if it destroys the environment. And that is always possible, even at full employment. As I think we've got a supporter in here, or several supporters of Shimomura in economics, for example, the Japanese economist Shimomura knew and implemented. So credit creation for GDP transactions explains GDP. You can show that econometrically. Credit creation for financial transactions explains financial markets. And simple rule, whenever broad credit creation rises much faster than GDP, by definition, this is fueling asset prices, unsustainable. This is Japanese data, so you have this huge bubble here where credit creation is way ahead of nominal GDP. But of course, the same story in Ireland, Portugal, Spain, and Greece from 2004 to 2007, 20 to 40, up to 40% credit growth for several years. Same in the US in the 20s. Scandinavia, 80s, 90s, the Asian crisis in the late 90s. Always the same story. Because concentrated banking systems are prone to these recurring crises and instability because, as Ben explained very well, the bankers have very different incentives. They usually maximize their profits by doing the financial speculative credit creation. But a banking sector dominated by local not-for-profit banks avoids these asset bubbles and banking crises. This is the German banking sector where 70% of banking, the green bits, are local not-for-profit banks, not owned by shareholders. And that's given us an example of a very stable system. These banks have never gone bust in the last 200 years. And in aggregate, therefore, credit creation was in line with GDP. There was no indigenous financial crisis. Central banks. The official story is that they aim at stability of prices, growth, and currencies. And if you go through their speeches, it's always stability, 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 this and that. Where's the empirical evidence for this? Of course, there isn't any. That's not what we're getting, stability of prices, of growth, of currencies. Central banks also claim that they pursue this stability using interest rates, and we know already, well, that can't work, that can't be true, because rates follow the economy. The fact is, central banks often cause and exacerbate cycles. If you look up my book, Princes of the Yen, the last chapter, the ECB had just been newly created. Due to its particular legal status of being totally independent and unaccountable, and based on the analysis of central banking presented in the book, I concluded that the ECB was likely to create massive credit bubbles and banking crises and economic recessions in the Eurozone. Already from the following year, they started to implement that by pushing up credit creation in Ireland, Spain, Portugal, and Greece, and the rest is history. Now, the ECB has said during this process, while they've been supervising the creation of these bubbles, that, we need to implement structural changes. And when the crisis started, they pointed out, this is an opportunity to implement structural reform. Deregulation, liberalization, privatization, the neoliberal Washington consensus. That's the same story we heard when the Asian crisis was created by central banks. We need deregulation, liberalization, and privatization. And the World Bank even said crises are this window of opportunity for structural change and transfer of ownership. So central banks have actually in the last 20 years become more powerful than ever anywhere in history. And they can choose their tools, often even their goals. And yet during this time period, the frequency and amplitude of cycles has increased. Now, Samuelson, who's a great economist, writing some great textbooks, introduced the very useful concept of revealed preference, according to which it's clear that central banks are choosing to create massive cycles. That is their revealed preference. There's also the theory of bureaucracy, which says that bureaucracies want to maximize their power. Each time a crisis happens, central banks get more powerful. They ask for more power, they're granted more power. And through cycles, they can maximize their power. So the alternative hypothesis that central banks have the job to create cycles is supported by empirical evidence. Now I want to wind up by two more points. One is interest. We're being told interest is so important. You've seen already empirically this doesn't quite add up. Now there are theoretical justifications for charging interest, also known as usury. And here they are. I can't go through them, but one is opportunity cost. All these are based on the premise of a system that we don't have. When we realize that banks create money out of nothing, all of these justifications go out of the window. Interest is not needed. It is not justified. There is no economic justification. It's just a transfer payment. You might have seen Matt's cartoon there, payday loan employee working for Wonga or somebody like that to his neighbor. Some time ago I lent you my ladder. You now owe me 236 ladders. It's a transfer payment, and of course, it achieves regressive distribution very effectively over a very short time period. But it also creates the pressure to grow, to deliver dividends, because we have this debt-based monetary system, debt that needs servicing through interest, and that is why we have the problem of the economy being pushed against the resource constraints and resulting environmental damage. So interest rates are just a regressive transfer payment that increases inequality, but that also destroys the environment. And my last point, I'm out of time, about economic growth. The official story is, oh, we need growth. Are you thinking critically here about interest and banking? Oh, be careful, you may damage growth. We need growth. Without it, there won't be employment, we'll lose our jobs, our prosperity will be endangered. So growth is a necessity, and therefore some costs have to be taken into consideration. But the fact is, there is no growth. That's one of these many examples of claims that are not true. There is no growth. Ask a physicist, what's that supposed to be, growth? Planet Earth is a closed system. We receive constant stream of energy from the sun. We take some of that in, but then what we're doing with our economic activity is just transferring energy. And that's it. It's a transfer, law of conservation, but from a state of less chaos to more chaos, the law of entropy. So what is GDP? Oh, it's just an artificial measure concocted in order to come up with a positive figure by not counting all the negatives, such as depletion of the environment, depletion of resources. What it actually does is it shows the ability of the economy to service debt. That's what GDP was created for. And therefore, it's a fiction that is used to perpetuate this debt-based monetary system and transfer wealth from the many to the few. So policy lessons, number one, we need to do something about this. Credit creation needs to be controlled. Credit guidance, the Bank of England has started 2 days ago. The announcement that they're going to have caps on particularly lending, but there could be a more elaborate system. We need to think about a decentralized system of money creation through local banks, and also taking away the privilege to create money from banks in general. And I think I better stop there. There's more in the book, such as New Paradigm Macroeconomics, or the jointly authored book, Where Does Money Come From? Thank you very much.